Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for a while now. Really great insights, long-time track record, managing money, 30 years in the securities industry. He's worked on Wall Street for a long time at investment banks, also ran a hedge fund. He was a senior portfolio manager for Silver Arrow Investment Management, a concentrated long-only hedge fund with options-based hedging. He also is the founder of Deep Knowledge Investing. It's a very successful investment newsletter, lots of winners over there, not that many losers as well. Very good track record with his paid newsletter. Gary Brode, thank you for joining me again.
Thanks, Jason. I appreciate you having me.
And Gary, you're a first-time guest. I feel like we've been speaking since we've been speaking for a while now before we hit the record button. Just want to thank you again for joining me. We're recording this interview on Friday, April 12th, 2024. The dollar index has rallied substantially lately the last couple of weeks to 106. Gold has been on fire the last couple of months, I think around 25% gain up to 2,342. And the 10-year U.S. Treasury in the last couple of weeks, it just touched 4.5%. It was only at 4.2% yield. I want to get your thoughts, though, on the asset markets, different asset markets, and the real economy in the U.S. How do you view the different asset markets right now, the major ones like stocks, bonds, real estate, commodities, and in the real economy?
So let's take the last one first, the real economy. It's been faked. We've talked before about a bifurcated economy, but the numbers that we're getting are so untrue right now that there's really no way to make sense of it or to get from the numbers that are coming out of the government and compare them to the real economy. So let's go through a couple of examples like that. One is, we've been talking about the CPI, the Consumer Price Index. That's the number that people typically refer to as the inflation index, right? When people talk about inflation, they talk about the CPI. And that index has so many adjustments to it that it's basically made up. Now, two of the ones worth talking about, the biggest one is something called OER. It stands for Owner's Equivalent Rent. And that change was made a few decades ago, which basically, instead of actually tracking home prices, which is about 1/3 of the index, they went to homeowners and they said, what if you were to rent out your home, what do you think it would rent for? Nobody knows, right? Most people who own homes aren't thinking about renting them. And so we've charted this, and I've actually put this chart up on Twitter or X. We've put it up on Deep Knowledge Investing a bunch of times, but we've tracked the change in actual housing prices, actual real estate prices, what people pay for shelter, and compared it to OER, the owner's equivalent rent. And the difference is astounding. So much so that in 2022, we were calculating at Deep Knowledge Investing that the actual inflation rate was approximately double the reported rate. And the main reason for that was this OER calculation. I would just give you one more example on it. The food inflation number the last few months has ranged somewhere between 1.2% and 2 point something percent. It's been under 3% for months and months and months. I think the one we got earlier in the week, this is from memory, was something like 2.2%. So Jason, let me ask you a question. Is your grocery bill up only 2% in the last year?
Stagflation and shrinkflation at the grocery store, restaurants, it's a permanent thing the last couple of years, I would say. It's almost like every month, it seems, that the menu prices are changing now, or my grocery bill or Target or Walmart, the consumer staple stuff is going up, and I'm getting less goods for more dollars.
That's exactly it. And so, I've been challenging people, not in a bad way, but I've been in public on my blog, on Twitter, on LinkedIn, on YouTube, and just saying to people, hey, if any of you have a grocery bill that's up only 2%, please let me know. I actually want to know. And the answers I get from people, everybody pings in, and the numbers all fall between 20% and 50%. And some of them are telling us this. I'll give you two more examples. One, we got a PPI number yesterday that was adjusted that showed energy prices down. A lot of that was gasoline. Now, Jason, I know you live in Washington where a lot of people don't have cars, but I'm in Connecticut where everyone has cars. I can assure you that no one in this country is paying less for gas than they were a year ago. And when you look at it, the difference is an adjustment, which basically means the government looks at the numbers, says, we don't like these numbers. We're going to report something that's completely different. And there's been a trend, and this trend has been going on I've been tracking it for a couple of years, where on announcement day, these numbers get a ton of attention. You have all kinds of traders and investors and analysts and people like you and me who are sitting in front of our computers at 8:30 when these things are 8:30 in the morning when these things are announced, and we're looking for these numbers to make sense of the economy and what we think how it's going to affect stock prices. And there's this trend where the number that's announced is often very favorable. It's exactly what the government wants, right? Growth is always good. Inflation is always low. Employment is always up. But then what happens is over the following months, when nobody's paying attention, there are very quiet revisions. And we've seen that a lot in the employment reports. And the employment report may be the most faked number coming out of our government out of all of them. We've seen this trend where we'll get a beat one month by 50,000 jobs. And, the market will trade off of that. People are like, oh my God, this is great. The employment number is terrific. But you'll see that number will be revised down. Or, if the beat is by 50,000 jobs, they'll revise the prior month and the month before that. They'll revise a couple of months before that. And if you look, the cumulative decrease in the revisions may be down 75, 80,000 jobs. But everyone's focused on the good number. But they're actually, if you add it all up, are fewer jobs.
Wasn't there a couple weeks ago, correct me if I'm wrong, didn't they just remove 800,000 jobs that they said were created in 2023?
That's exactly the number, right? We had a Federal Reserve branch who basically had to admit, oops, right? We've overcounted by 800,000 jobs. That's a huge number. For the people listening to this who don't look at these numbers on, a weekly or a monthly basis, we've had a lot of job additions in recent months, and frequently you'll see something like 200,000 jobs. So when they wipe out 800,000 jobs, that's like 4 months of job additions that just disappeared. I'll give you another example. All of the growth in new jobs has not come from full-time employment. Since 2018, there's been no growth in full-time employment in the United States. So you say, wait a minute, but I thought you were telling me we're adding 200,000 new jobs a month and the unemployment rate is low. Yeah, that's more people taking more part-time jobs. This isn't more people working. This is the same people working more, trying to make ends meet. And, you see in the Wall Street Journal and the other press, we get, weekly articles castigating Americans, criticizing Americans for not being more grateful for the terrific economy that we're living in. Well, the last thing I'll add on this is all of the new job growth, and even though they're part-time jobs, come in government. Okay, so the government is printing money to create their own jobs. They're literally creating their own jobs report. And it comes in another place, healthcare. Well, that's more than 50% funded by government. So, go ahead. Sorry, I apologize.
So for healthcare, it's what Medicare, Medicaid, illegal immigrants, Social Security. So those are government checks that are going to hospitals to subsidize that stuff.
That's exactly right. Yeah, the government is paying more than, and you also have the people on the ACA exchanges, the Affordable Care Act exchanges. So if you're an individual, if you're self-employed, and you're not working for a large corporation, you almost certainly have to get your health insurance from one of your state exchanges. And those run with gigantic subsidies. So, here in Connecticut, if you are an individual, your health insurance premium might be $1,200, $1,300 a month just for one person. And if you're self-employed, that's where you'd get your health insurance from. But there are income tests for that. And so if your income isn't high enough, the state will subsidize part or even all of that. And these people are thinking, great, I'm getting free healthcare. And, that's we can have a discussion another time about the advisability of having the government in charge of your healthcare. But the fact is that the government is still paying for it, even though you've gone out and gotten your own insurance. So,
and they're also measuring in the CPI, aren't they measuring Medicare and Medicaid reimbursement? So they're not measuring that accurately either.
Not only that, on top of that, last year was a giant change in the way they calculated the healthcare insurance adjustment, I think they had it down something like 18%. Now, again, this goes back to the prior point of the government will announce numbers. They'll announce statistics that make people feel good, and then later they'll adjust them. And so, Jason, let me just ask you, are your health insurance costs, were they down 18% last year?
None of the insurance, car insurance. I think the insurance companies, that sector, I think is getting killed with commercial real estate exposure and losses on older bonds. And I think that's the main reason they're raising the insurance premiums. But the consumer price index is not counting that the small business owner or the consumer, we have higher insurance costs on everything.
Yeah. And on top of that, there's also something called basically a hedonic adjustment. I know that sounds really confusing, but it's actually really simple. They basically say that because the computer you got or the car you got is better or nicer or faster or, just has more bells and whistles than the one that you had 10 years ago or 20 years ago, that the price didn't really go up. Except, Americans don't live off of hedonic adjustments or inflation rates. We live off of actual prices. Anybody in the real world, you go to the supermarket or you go to buy a car, the price is the price, regardless of how it's adjusted in government statistics.
And most people's monthly budgets are what? Healthcare, rent or mortgage payment, utilities and food and transportation. So those are the 4 or 5 main ones. And I don't think the consumer price index reflects those at all. With owner's equivalent rent, Gary, I think what the government could just do, they could fire all these PhD economists, and there's already better data. I'm friends with a real estate agent. They could just go to Redfin or Zillow, National Realtors Association, Rent.com, Nick Jurley. They have all these data with good rent numbers for all the major cities and metro areas or mortgage payments, and they could just collect the data there and pay for a couple newsletters and fire all the government employees.
You got it now, Jason. I would take Zillow has an index to measure real estate prices. It's called the Zori index, Zori. I would take that over the OER number that we've been talking about. Basically, I prefer Zillow's numbers to our government numbers. And yeah, they announced that for free. So, we could lighten up the load on the taxpayer.
Well, rational common sense thinking doesn't work here. In fact, I think they're already talking about commercial real estate bailouts and how they can pad the jobs reports with that after the November election.
I'm quite certain that's the case. So, your original question was what's going on in the real economy? And so, we've talked about the inflation numbers being faked, people struggling to pay their grocery bill, jobs numbers that are being faked, the government printing more money to create the economic data that they want. And, we're getting criticized every week by the press. Why aren't we more grateful? And the answer is because the government can print whatever numbers they want, telling us the economy is wonderful. But for most people, it's not so wonderful. A lot of people are living paycheck to paycheck. And, there have been stories which sound funny, but are a little bit scary, of more and more people using buy now, pay later. I don't, Jason, you tell me which of these scares you more. I'm reading stories about people who go to McDonald's or Burger King. They're using buy now, pay later to put a Happy Meal or a value meal #1 on layaway. So that, or alternatively, we're hearing about people paying 20% premiums. No, Jason, I apologize. You were the one who told me about this. You were the one who told me people paying 20% premiums to use buy now, pay later on their rent.
Yeah, that was from Ken McElroy, the billionaire real estate investor. So he has over 10,000 tenants. He owns giant apartment buildings, a lot of them. And he said he's never seen this before, that over the last 6 months, he has younger adult tenants and there's a middleman. So it's basically like this middleman app where the tenant can't pay their rent on time. So this other middleman is paying the rent for them. And he said 10% of his tenants now already have the service. So they're paying a way higher rate.
Yeah, I forgot. You were the one who passed that information on to me, and the whole thing is incredible. Another place where the data is being faked. This isn't government data. You were not talking about private data, but there have been a ton of stories of in the commercial real estate space, people who own office space, and they don't want to show a decrease in the rent. So they've got giveaways. So, for instance, Jason, let's say you and I, we have a business together and we have an office somewhere, in New York. And let's just say our rent is $10,000 a month. And, our lease is up and we say to the guy, hey, listen, your building is 50% empty. We don't want to pay you $10,000 a month. And the guy says, okay, listen, I can't have that number down. I need to show that, the rental rates aren't decreasing. And so what they're doing is saying, listen, you need to keep the rate at $10,000 a month, but I'll give you a month or two for free, and, we'll renovate your office for you. And so people are saying, okay, well, I'll have a nicer office. And, whether you pay $10,000 a month for 10 months or, something less than that, like it adds up to the same thing. They're basically rent reductions, but they're done in such a way that they don't have to report rent reductions. So it's not just the government that's faking the numbers. But, when you start to see stuff like this, everywhere you look, you realize this is not a healthy economy. And, people will say, okay, wait, but what about the stock market? And there again, you have, it's not a bifurcation. We're going to make up a word. It's a trifurcation. So, at the top you had last year was the Magnificent Seven, but, you've got issues there, right? Tesla stock hasn't been doing great. Apple is seeing declining unit sales, right? I mean, we're really down to 2 or 3 companies that are now mega cap companies running the whole market. The S&P 493, the rest of the S&P 500 really isn't doing much. And then when you start to look at the Russell 2000 index, the small cap index, those stocks are doing pretty poorly. And so, people say, well, asset prices are up and housing prices are up. Well, housing is expensive for people, and it's not the whole market that's up. You have a few mega cap tech stocks that have led the whole market. And so there really is a huge difference between asset prices and the quality of the economy and people's lives. And, you asked about gold before. That's part of it, right? That you're seeing people fleeing, taking money out of the system and saying, I want something in a safe harbor. And gold is that. And then the other thing, and you and I have talked about this privately, the Congress is overspending by, right now, it's about $3 trillion a year. We've seen interest expense on the debt in the last few years go from, it was around 400 to 600 billion. Now we're at a run rate of about 1.6 trillion. And that's going up at a parabolic rate. And that's just, a fancy way of saying that the rate of increase is increasing. And, we're going to see $2 trillion of interest expense coming up soon. And so what Washington is doing is they're printing more dollars. They're creating more currency units, but we're not producing more. And when you have more dollars chasing the same number of things or fewer things, you have an increase in pricing. And so what's really interesting about it is, and I can tell you, I own gold and Bitcoin and oil, energy, I own a little bit of silver. I like owning dollar alternatives in this. And people are saying, well, great, gold is at an all-time high. And between the two of us, yeah, that makes me happy. Great, I've made money in it. But there's a huge difference here. Gold is up in dollars, but dollars are down in purchasing power. And what we're really seeing is not an increase in the price or the value of gold. What we're seeing is a decrease in the purchasing power of the dollar. As the dollar loses value, the price of gold in dollars goes up. But what you can buy with an ounce of gold isn't really that different from what you could buy, 10 years ago or, 100 years ago or 2,000 years ago, right? Gold has pretty much held value for thousands of years. It's the fiat currency, and fiat is just it's a fancy way of saying a government currency. The US dollar, the euro, the British pound, the Japanese yen, those are all just fiat currencies. But they're losing purchasing power. And that's what we're seeing with gold right now. So even though, it's been a great profitable position for me and for Deep Knowledge Investing subscribers, the real story is that Washington is printing so many dollars that we're losing purchasing power. And that's a problem for people who don't have investment accounts where they can put substantial amounts of money in the kinds of alternatives that I talked about to protect the value of their savings. They're forced to save in a unit of account, the dollar, that loses purchasing power every single year.
I think you just highlighted that there's a huge supply and demand issue for U.S. Treasuries, and a lot of it is the budget deficits. And then you add in the Fed raising interest rates, the lag effects in the real economy. So the consumer who's not affluent and doesn't have a locked-in 30-year mortgage. They're exposed to variable interest rate debt. They're dealing with stagflation, shrinkflation, tax increases. Their standard of living, like you said, with devalued currency is in question right now. But then the people who don't have exposure to variable interest rate debt, say credit cards, say they can pay their credit card bill back at the end of every month, and they have their mortgage locked in at 30 years at a low interest rate, and they own a lot of these assets, they're doing well. So this is basically like, it's not even the Pareto principle 80-20, it's like 90-10, I think now with wealth disparity.
So not only are you right, the thing that really bothers me about it is the same people who are pushing these horribly destructive policies claim to be doing it on behalf of the average person, on behalf of the poor person. And when their policies create wealth inequality, they complain about it and act like it's somebody else's fault. So, let's talk for a minute about who benefits from this and who's hurt by it. I think it's really obvious that when the government is spending a lot and printing a lot and creating a lot of dollars, that reduces the purchasing power of the dollar. And so let's say you're an average person, you're, middle class, or, maybe somebody in the, 20th percentile, 40th percentile, where most Americans are. What that means is they don't have a lot of assets that they can get the benefit of increasing asset prices for. Their costs are going up, and any savings they have will be in dollars. And those savings will lose purchasing power every year. And I assure you, the purchasing power they lose every year will be much more than the CPI that is reported. So these policies hurt poor and middle class people. Now, who benefits from this, right? And I'm raising my hand on this. I own a lot of stocks, right? I've been in the investment world since I graduated from college in 1991. I've spent my whole life investing. So when all of this money flows into the economy, what it ends up doing is blowing up asset bubbles. It's great for people who own stocks. Even better if you own hard assets that you can leverage. So, and again, I know that terminology may be sound challenging for some people, but it's really simple. If you were to buy a home and have a mortgage, you're in great shape the last few years. So, in my case,
well, if you locked in when the Fed lowered interest rates, yeah.
That's exactly right. And again, it's the advantage of, doing what we do for a living. But in the fourth quarter of 2021, I refinanced my mortgage, and I locked in. It wasn't just for 30 years. It was interest only for the first 10 years and at a fixed rate. And I think that rate is right around 3% or so. And so think about it this way. Every month for 30 years, I'm going to write the bank a check for, the mortgage amount, and that amount won't change. But what will change is the value of that amount. So let's just use a hypothetical number. Let's pull a number out of the air and just say the monthly check is $1,000. So every month I would be hypothetically writing a check for $1,000. Okay. But 30 years later, I'm still writing that check for $1,000. But the value of that $1,000, the purchasing power of that same amount of money declines. So every month I pay the bank the same amount, but I'm losing less purchasing power. Now, the other side of that is if you own a house, that's done really well when the Fed had low interest rates and blew up a giant asset bubble. And so the people who pursue these policies of excess spending and money creation, and they claim they're doing it on behalf of the poor, on behalf of the middle class, and they claim they're doing it to reduce income inequality and make life more fair, those policies are creating the exact conditions that they're claiming these people are against. The people who are claiming they're in it to help the poor people in the middle class are the ones crushing those people and ending up blowing up an asset bubble that benefits a very small number of people who own their homes and know when to refinance their mortgage and have assets and can do things like buy gold or buy Bitcoin or buy oil or energy or uranium. Like there are all kinds of ways to play this inflation trade, and we've made a lot of money doing it. We've made a lot of money for our subscribers doing it. But I'm very aware that the only thing I can do is I can react to the conditions. I can't change the government policy. I can just tell you that the government's policy is horribly destructive.
We're in agreement. I mean, it's all about the Cantillon effect and the government stealing as much, at least like the parasites that are here in the DC metro area are stealing as much as they can. The average person doesn't know that the DC metro area has 5 of the 10 highest average median family income counties in the whole country. And the technology companies, all the big ones, are all moving corporate headquarters here or buying giant buildings. So you have all the cybersecurity tech companies all moving here. This area is very affluent compared to even like 15, 20 years ago. A lot of it started during quantitative easing and central bank balance sheet expansion. Zero interest rate policy.
That's right. And one thing that's really strange about the job that I have, the job that I do, right, which is stock picking, is making money, helping people make money, helping people get better returns, is you really have to wear 2 hats. So, Jason, when you and I chat on Twitter or when we talk privately, we understand, we talk about how destructive these policies are. And I don't like them and I think they're wrong. But when I go to work, when I sit at my desk, my responsibility isn't to decide right and wrong. It's to figure out what's going to happen and how do I help my people, how do I help my subscribers, my clients make money from it. And so, one of the things that we say at Deep Knowledge Investing is, we don't have any patience for people who claim it's a good market, it's a bad market, we can't make money because it's a bad market. No, it is our job, no matter what the conditions are, whether it's a good market or a bad market, to find a way to figure out what's going to happen tomorrow and how do we position our people to help them make money from it. No complaining, no whining. We don't need the Fed to bail us out. It's a very strange position to be in where, on one hand, I talk to you and I'm like, what's happening is wrong. But on the other hand, it's my job to help people make money from it.
It's important. Yeah, you have to be realistic when you're either managing money as a hedge fund manager like you've done in the past or as a newsletter writer.
That's right. And if I could change the policies of the government and make them better and more fair and create better conditions for all Americans, not just, my peer group, I would absolutely do that. But I don't have that much power. I don't have the power to change the government. I only have, the wit and the intelligence and the work ethic to figure out, okay, this is really bad, but now what do we do? Right? How do we make this work for our people? And it's a strange position to be in where I'm saying these are bad policies. All right, but how do we help people get through this? Right? These policies will create bad times. How do we help people protect themselves?
And I think we're seeing this now. You mentioned complaining. We're seeing this on business television. So the mainstream Wall Street people are on there saying gold has gone up too much. Commodities have gone up too much. They're going to crash. I don't understand why gold's going up. Maybe they've repeated a couple talking points that they spent on a couple minutes of search prior to that. So you're seeing, and then a lot of the people are saying, oh, the Fed has to cut rates soon. Fed has to cut rates soon. And then my bonds, all the treasury bonds that I'm buying, TLT and some of those other stuff, those things are going to pay off big.
Yeah, I wouldn't bet on that. I can tell you, and we put this in writing. So rolling into, everybody who does what I do for a living, at the end of a year, everybody says, okay, here's our forecast for the following year. So in the fourth quarter of 2023, everybody comes out with, this is what we think is going to happen in 2024. And, Jason, the base case rolling into this year was the Fed would cut 6 times for a total of 1.5% in interest rate cuts, starting probably in January, at the latest in March, and that we were going to have a recession. And all of these asset gatherers and the people that you were just talking about who spent, 5 minutes reading headlines, we're saying the Fed has gone on too long and we're going to have a recession. We're probably already in a recession and, we don't even realize it. And the Fed has to cut. And, my position was, no, this is all entirely wrong. The real economy is not good, but what people often forget is that government spending is additive to GDP, gross domestic product, whether it produces value or not. And we saw that in the first quarter. The increase in government debt was greater than the increase in GDP. And what that's telling you is, 1, government spending is destroying value, and 2, the private sector is floundering. And so I looked at this and I said, okay, here's what's going to happen. The government is not going to reduce spending, particularly not in an election year. Both parties will overspend, right? No incumbent wants to run on an economy where, you're showing negative GDP, or you have stagflation, which is high unemployment and a recession and high inflation, which, everybody thought was going to happen. And I said, no, the government is going to spend so much that the GDP numbers are going to look good regardless of reality. We're going to have strong GDP numbers, again, faked, but that's the data the Fed is going to look at. And then we're going to have a resurgence of inflation. And, when people were saying 6 rate cuts starting in January or March, our response was, no, absolutely not a chance. Don't bet on it. And then, as little as a few weeks ago, the base case was 3 cuts starting. People thought we were going to get a cut in March. And now, in June. I apologize. 3 rate cuts starting in June. And I looked at that and said the same thing again. We're taking the under, not a chance. Now the expectation, people are debating somewhere between 0 and 2 rate cuts and starting in September. And, this is, again, people were talking their own book, right? When I talk about asset gatherers, these are people who get paid a percentage of assets under management rather than based on performance. And so, think about it this way. If these guys make, 50 basis points, 0.5% or 1% of assets under management, and the Fed lowers interest rates, right? What does that do? It blows up an asset bubble. Asset prices go up. This is what we were talking about before. Stock prices go up. And, if they can get the market up 20, 30%, their income goes up 20, 30%. So, they can talk their book, but the Fed is going to be staring down higher inflation, fake GDP numbers, and fake unemployment numbers. And so the same people in Washington who are screaming, we need the Fed to lower interest rates so that we can get reelected, are pursuing economic policies that are going to make it impossible for the Fed to lower rates.
We're in agreement here. Yeah, there's a lot of stuff in policy decisions here in DC that doesn't make sense, but the Fed has been the great enabler of all these budget deficits. I mean, the budget deficits for many years were $1 trillion per year, but now they've blown out even worse than that.
Yeah, we're adding something like $1 trillion every 100 days. And even, we talked about this. We put out a weekly piece called 5 Things to Know in Investing this week. And we talked about this last week. The CBO, the Congressional Budget Office, they put out a chart saying that the U.S. would get to 166% debt to GDP in 30 years by 2054. But here's the numbers. First of all, they're showing that our current debt to GDP is 100%. That's not true. Right now, we're somewhere between 125 and 130%. We've got a $27 trillion economy. If we're adding $3 or $4 trillion of debt every year, right? What's the math on that? It's not going to take that many years to get us to 166%. And I was so confident on it. We actually offered a bet. This was on a YouTube video. And we put it in writing. I said, I will put $100,000 up and bet anybody who will take the other side of it, who wants to take the over, right? I'll bet you $100,000 we hit 166% of GDP well before 2054. I'll take the under on 2054. You take the over. So far, no takers. So, somebody who believes the government is right on this, you can come take my $100,000.
Doesn't sound like we're going to have a lot of deflation allowed. Sounds like the path of least resistance, at least historically, is to inflate the debt away. But then, it sounds like also the Federal Reserve Bank is more or less trapped by all the spending DC's doing and the lack of foreign demand of treasuries that used to be prevalent for the last 2 or 3 decades, where China, Germany, Japan used to be large net buyers of U.S. treasuries.
That's exactly right. The Federal Reserve is trapped. And one thing that we've been talking about and writing about for the last year has been the quiet war between Powell and the Fed on one hand and Congress and the Treasury on the other. So Powell and the Fed have been raising rates in a desperate attempt to get inflation down. And that's the right thing to do. And, that's the instrument the Fed has. That's what they can do to try to get inflation down. That's been the historical prescription. You correctly before said, hey, a lot of the blame for what's going on now falls on the Fed. And Jason, you've got it nailed, right? They kept rates at or around zero for almost a decade and a half, and then ran up $9 trillion in quantitative easing. The balance sheet was $9 trillion, including $2.5 trillion of mortgage-backed securities they're not legally allowed to own. If any of you want to know why housing prices are so high, it's because the Fed put interest rates at zero and then meddled in the mortgage market, right? That's the reason your housing prices are high. The Fed has tons of blame. But despite that, they've actually been doing the right thing for the last couple of years, which is to raise interest rates and not blink. And they've held firm. They've actually, even though they created the problem or were a giant part of creating the problem, they have acted correctly in the situation. But on the other side of it, if we go back to what we've been talking about for most of this conversation, Congress is overspending, and which forces the creation of more dollars. They have to come from somewhere, and it's coming from debt. And the Treasury Department, led by Janet Yellen, who is horrible at her job, they're monetizing the debt. And that's just a fancy way of saying that instead of paying for our bills through taxation or doing the right thing, which would be to lower spending, we're just issuing more debt. And so everything that Powell and the Fed is trying to do, the Congress and the Treasury Department are undoing. And the problem is the Fed is completely trapped because there is no universe where Congress is going to stop spending. And I know there are people who will say, well, if we just get the right president and the right Congress, and listen, Jason, economic history as well as I do. And in our lifetimes and in our business lifetimes, the times that we've followed the markets, we've seen every combination of total Democratic control of Congress and the White House, total Republican control of Congress and the White House, mixed control, where one party has the White House, the other party has Congress, then reverse that. We've seen every possible combination. Jason, under what conditions has Congress reduced spending?
I mean, they claimed that they had a balanced budget in Bill Clinton era, but there was a lot of stuff they weren't counting.
There was that. There was also this just really weird, talk about asset bubbles, right? There were really weird tax receipts that came from, all the tech IPOs and all the capital gains that happened for, basically phantom businesses, right? I mean, the crazy thing is people were paying capital gains on pets.com. And so, and you had everybody buying Cisco hardware because, they were going to pay to buy eyeballs and then monetize that. And, those businesses all imploded a few years later. But, there was just a really unusual confluence of circumstances that led to greater than expected tax receipts, which was never going to be sustainable.
Yeah, I mean, I think they're in the budget projections for fiscal 2025. They're just expecting to collect another $1 trillion of tax receipts, and they're claiming that the budget deficits will only be 1.8 trillion, which is they're making just absolutely ridiculous assumptions.
Okay, so Jason, let's put a bet up here. I'm going to take the under on the tax receipts and the over on the budget deficit. You think you want to join in with me on that? You think anyone listening to this is going to take the other side of that bet?
Well, I mean, they would get a lot more crypto capital gains taxes if they can if crypto get manipulated. But I mean, if the stock crashes, you've been writing about this in your newsletter, the yen carry trade unwind. I mean, if the yen carry trade, first of all, please tell my listeners what the yen carry trade is and what bad things could happen if it starts to unwind.
Yeah, this is a giant risk in the market that people are just starting to understand and is 100% not priced in. We were early on this. There's a lot of video and writing of me and a guy named Mark Rossano from C6 Capital, who's somebody I respect a great deal. The two of us were out in writing and on video in October of 22, a year and a half ago, talking about Japan facing a sovereign debt crisis. And, now people are just starting to realize that and the implications of unwinding the carry trade. So let's take people through it and unravel it in just plain English. First, what happened with Japan is they had their version of the Federal Reserve is the the Bank of Japan. And the Bank of Japan was even more aggressive than the US Federal Reserve. And they had interest rates at a negative level for almost a decade. So think about that. Imagine, putting your money in the bank and saving for 10 years, and the bank says, okay, here's, your money with interest, so you get less. People were somehow saving in this. And so what happened was the Japanese government said, wait a minute, it costs us nothing to borrow. Money is free. So they printed lots of yen, spent lots of money, and they ran up their debt to GDP to 260%. Now, for people who are listening to this and aren't looking at numbers like this all the time, above 100% of debt to GDP, people start to get concerned. At 260%, you're basically an emerging market currency disaster. But the problem is Japan has fluctuated over the last however many years as somewhere between the third and fourth largest economies in the world. Japan and Germany have traded spots a few times. So we're talking about the world's third or fourth largest. I think now it's the fourth largest economy in the world that has basically emerging market level debt. Okay, so what happens is because the interest rate on Japanese government bonds were negative, or for anything longer, they were, even the 10-year was trading very close to zero. The 10-year was trading at something like 25 basis points, a quarter of a percentage point. People started doing what was called the carry trade. And again, it sounds complicated, but it's actually really simple. So let's imagine for a minute that Japanese 10-year bonds are trading, at 25 basis points, a quarter of a percent. And then let's say, the 10-year US Treasury was, at the time, let's just call it, 4.25%. And it's, there have been times it's been at that level, times it's been lower, times it's been higher, but we're just sort of making a hypothetical example to make it easy to understand. So what people were doing is saying, wait a minute, what we can do is we can sell Japanese government bonds, and our interest expense against us is negative 0.25%. And we can buy US Treasuries, and the interest we receive is positive 4.25%. And in this case, you would earn 4% to have this trade on. And, of course, like, Jason, wouldn't you like a free 4%, right? That sounds like a great idea.
And they were leveraging this up too. So this was mostly done by hedge fund managers, global macro hedge fund managers, and portfolio managers at banks managing capital, right? So they would borrow, like you said, in yen. And were they also buying US stocks with it, like S&P 500 too?
So they were, but that wouldn't be classified as the carry trade. So they were doing that, but that wouldn't be a carry trade kind of thing. But trillions of dollars of capital were committed to this. Well, so supply and demand, believe it or not, actually applies to currencies just like they do everything else. The thing that's in demand becomes more expensive. The thing that people are trying to sell becomes cheaper. And that happens even with fiat, right? With government currencies. And so you had all these people who wanted to buy the dollar because we had relatively high interest rates, and they wanted to sell the yen. And so the dollar became stronger relative to the yen. Now, the key thing here is, we've talked a lot about, people will talk about the strong dollar. And one of the things that I've been saying for a couple of years to correct people is your view on whether the dollar is strong or not depends on whether you're a foreign currency trader or an American consumer, right? So the dollar, because our interest rates have been higher, have been very, very strong against the euro or against the yen. But, if you want to go buy, pay your rent, or go buy, fill up your car with gas, or go buy food, the purchasing power of the dollar is declining. What it meant was the dollar was declining in purchasing power, but other currencies were declining faster against them. And so the dollar looks strong if you're a foreign currency trader. And that's what happened. And in the last couple of years, I think if we go back to the beginning of 2021, the yen was, it was something like 102, 103 yen to the dollar. Now, as of earlier today, it was 153 to the dollar. So the yen declined in value against the dollar by 50%. And that, by the way, was the risk of the carry trade, right? The risk of the carry trade is, you think, wait, I'm getting a free 4%. Yeah, you're getting a free 4%, but you're taking foreign currency risk. You're long one currency, you're short another currency. And if the relationship between those currencies move, it can create problems in your portfolio. I mean, it can also create excess profits, but that's not so much of a risk. So what's happened now is, imagine, let's just take a step back. If you're listening to this, my guess is you have been livid, upset, or worried about the inflation we've experienced for the last 2.5 years or so. It's really unpleasant. When Americans see prices go up 5% or 10%, we get really upset with good reason. If you're upset about this, guess what? I am too. You have every reason to be upset by this. But now put yourself in the position of being somebody who's in Japan, and the value of your currency has plummeted 50%. And the really big problem is that Japan is a small island nation without a lot of natural resources, and they are really short of energy. And energy, because of the petrodollar deal, which Secretary of State Henry Kissinger struck with the Saudis back in the mid-1970s, means that oil has been priced in dollars. So, imagine this, right? We all get angry. We go fill up our car with gas, and gas prices are high, and we don't like that. But now try to imagine if the value of your currency had fallen 50% against the price of oil, right? It's even worse there. So the Bank of Japan is really, like we talked about, Jason, we talked about the Federal Reserve being in a bind. The Bank of Japan is really, really in trouble. And here's why. If they keep interest rates where they are right now, and they just changed their reference rate, they made a big deal of saying we're going from negative to positive. Well, they changed it from a range of 0 to, I think it's 10 basis points. So, the average overnight Japanese rate is 0.05%. Great, good job, guys. If they keep their interest rates where they are now, what will happen is the yen will continue to slide against the dollar because our federal funds rate is 5.3% at the midpoint. So this is going to create a horrible problem for the Japanese people. And so the easy response is to say, okay, well, if you were the Bank of Japan, then just raise rates. Okay, well, Jason, we were just talking about the huge increase in interest expense that we're facing here in the US, that our US Congress is facing and monetizing, our Treasury Department is monetizing. Now try to imagine doing that in Japan to protect the yen, right? They would have to raise their reference rate, their overnight rate, in order to protect the yen. But if you do that and your debt to GDP is 260%, they're going to blow out their budget. Okay, well, you say, well, but Japan has a printing press too. In Japan, their debt is denominated in yen. So they can't default. They can create more yen. Well, we talked about this before as well. When the Japanese government creates more yen to pay the interest on the yen they borrowed before, and their interest expense will go parabolic. It'll skyrocket as a result of higher rates. What happens? So they print more yen. They have inflation. The value of the yen drops because you just have more yen, but you don't have more production. And so more inflation means that they would need to raise interest rates to address that. More inflation is simply a way of saying your currency is falling. The buying power of your currency is falling. So what do? Then they raise rates again. That creates a more interest expense, and then they print more yen. And you can see, do 2 or 3 rounds of this, and you end up with a death spiral.
So that's bad. Does the emerging market currency collapse, or people are scrambling? And we're starting to see this now with the data where people in Japan who have a lot of savings in Japanese yen, they're starting to buy gold like crazy. They're buying gold, physical gold, coin shops, coins bars, and then the Japanese gold ETFs, there's an enormous spike in it.
Yeah, if I were in Japan right now, I would be doing everything I'm doing here in the US, but faster, right? I would be buying oil, gold, Bitcoin, silver, anything, to get out of yen. Now, what's going to happen is the government is going to raise rates. Well, what happens then is people will have to start unwinding the carry trade. And you think, okay, well, is that a big deal? Yeah, it's a big deal because there are trillions of dollars of US treasuries held by people who own the carry trade. And when they unwind it, they're going to be selling trillions of dollars of US treasuries. When that happens, right? When you sell something, the price of it goes down. And if bond math tells you if the price of a bond goes down, the yield goes up, which again is a complicated way of saying the borrowing costs of the US government will increase. And people say, well, wait, can't the Federal Reserve set rates? No, the Federal Reserve can set overnight rates. The market sets the yield curve for everything longer than one night, for 1 month, 2 months, 6 months, 10 years, 20 years, 30 years. It's the market that sets that rate. And so if the carry trade unwinds, our borrowing costs go through the roof, and then we're going to have to print more dollars to pay the debt, and we end up with more inflation, which is the exact same thing we're trying to avoid ourselves. And so unwinding the carry trade can create a financial crisis here in the US.
Do you also think that unwinding the carry trade, is that going to cause other assets in the United States, maybe stuff that was invested in the S&P, not a pure carry trade, like you said, but where a portfolio manager or hedge fund borrowed in Japanese yen to go buy US stocks, let's say Mag 7 or some of these dividend stocks or something like that? Are those going to be unwound too?
So yes, but I might draw a different conclusion, right? So I mean, I see where you're going on this. If you have people who, as you know, have sold the yen and used the proceeds of that to buy US stocks, if they're unwinding that and they want to buy the yen back because they don't want to get killed on the new exchange rate, if the Bank of Japan raises rates, then they'll have to sell their S&P 500 stocks or index funds, and we'd have selling pressure there. And that could take down US asset prices. The reason I'm not completely convinced that that's the conclusion is because it'll end up creating inflation here in the US. And when that happens, that tends to be positive for asset prices, right? And so, again, we just saw the Nikkei, that's the Japanese version of the S&P 500. They finally hit the first new high they've had since I want to say it's either 1989 or 1991, something like that.
35 years, yeah, something. It's a long time.
Yeah, something crazy like that. But the thing is, the yen isn't worth now what it was worth then. And so they're saying, great, we're at all-time highs. But again, like
so it's a nominal bull market then. It's because of you're saying that the market is factored in with the devalued yen then?
Exactly. Right. That's exactly it. They're saying we're at all-time highs. Well, in nominal terms, yes. In real terms, not even close. Jason, the thing that worries me more about the US stock market on unwinding the carry trade isn't so much that people who are short the yen will also sell S&P 500 stocks. And you're right, that will happen. The thing that concerns me more about the US equity market is if you unwind the carry trade, the cost of our debt, right? The US Treasury, which is basically the risk-free rate, the reference rate that everything gets priced off of, the yield on that goes up. And when that happens, stock prices come down because you have a higher discount rate on future earnings, right? And so future earnings become worth less. And when that happens, not only do stocks come down, but the stocks that come down more are the high value, high growth tech stocks that have been leading the market on the way up. That gets unwound, and you're really going to want to have huge short positions in not just the S&P 500, but more likely the NASDAQ.
The funny thing is I'm hearing that a lot of people are predicting that all these other central banks in the G7, the Bank of England, European Central Bank, it sounds like Japan really can't do it, but I've heard a lot of people predicting that there could be coordinated rate cuts where they take turns now because the governments can't afford the interest payments on the debt. It just seems like all these central banks in the G7 are trapped and they don't have any good options.
Yeah, at some level, it becomes a shell game, or, we could use the word a Ponzi scheme, right? Where we're just sort of funneling money around just so, you always have it in your pocket when you need it.
Did you see that? I sent you a blog article from Kathleen Hayes. I think she's an academic and she used to work at the New York Fed, and she was talking about stealth QE, how all these G7 central banks should start buying each other's bonds.
Yeah, it's like the central bank version of a Japanese keiretsu, where everybody owns so much of each other's stock. It's kind of hard to tell who owns what, and it's a great way to obscure things. Again, it's a great way to extend a Ponzi scheme, but at some point, you can only hide these deficits. You can only hide this stuff for so long.
So Gary, I've kept you for almost an hour. Last question here. A lot of disheartening stuff here. The math is bad, but as an investor, you have to be a realist, but you also have to be an optimist, especially if you want to beat inflation, if you want to be able to retire. What sectors or industries do you think are at good risk reward valuations? And what do you think is going to benefit the most from all this shenanigans with bad policy and central bank mistakes?
So that's a phenomenal question. And the way I've positioned myself right now is, I've already told you, I'm long huge amounts of dollar alternatives or assets that will benefit from inflation. Again, I'm a huge fan of gold. I have huge positions in Bitcoin. Energy is great. Remember, oil is still, even though the petrodollar is breaking down, oil is still priced in dollars. So as the purchasing power of the dollar declines, you should see increases in oil prices. And that's a pretty good way to save and make money. And then, I'm finding individual stocks that I like a lot. I run a very concentrated portfolio. We run a portfolio without a lot of positions, but with an extremely high hit rate. We've literally in the last 4 years had more positions that have gone up by more than 100% than we've had positions that have lost any money. That's pretty hard to do, but that's the kind of thing that we're aiming for. And so, when I find stocks that I like and I commit capital to it, I will often take short positions against it so that my market exposure doesn't go up, but I have exposure to the companies or industries that I like. One thing that I'm looking at now, and you'll start to see me talking about it more in the next few months, is security. And I don't mean physical security. I'm talking about digital security. And that's, I think, going to be a huge growth market. And, I'm not ready to talk about that in public yet, but expect something in the next couple of months where we're going to be very focused on that.
So for commodities, the producers, I don't think they're pricing in. They've underperformed, whether it's the agriculture stocks, the MOO, the ETF, which is agriculture producer ETF, that's drastically underperformed soft commodity prices. You have the gold price up, but you have the gold mining stocks. They're just starting to perk up a little bit, but they've drastically underperformed the gold price. Do you think that this divergence is going to fix itself if commodities prices stay high over the next couple of years?
The answer to that is probably, but it's not a bet that I'm taking. And I get this question all the time. Jason, I'm really fortunate. My subscribers are an incredibly smart group of people. They're really good investors. I am fully convinced that if my subscribers wanted to get together, they're amateur investors. If they wanted to get together and run a hedge fund, they'd be successful. But the most common question I get is, why do you own gold instead of the gold miners? Right? Why do you own uranium instead of the uranium miners or the nuclear power plants? And my answer to that is because I want the pure play bet. And so, look, there's no question in a gold bull market, you would expect the miners to go up by more than gold. One of the reasons you haven't seen that, there are two main reasons. One is people do have certain concerns about the forward price. You'll often see oil prices go up, but oil stocks won't go up. It's because people are assuming some sort of reversion to the mean. But the more important thing is these mining operations are very, very labor intensive, right? You can't just buy another NVIDIA processor and plug in another server and say, great, we've increased our capacity. These operations are incredibly labor intensive. And what's happened to the cost of labor? It's gone up. And it's gone up so much so that, I told you we own a huge position in uranium. And a lot of people have asked me about Cameco, which is, the Canadian producer. They're one of the world's largest producers. From what I can tell, I haven't spent a ton of time on it. I think they're a well-run company. I have nothing negative to say about them. But Cameco is so hesitant to open new mining capacity that the last couple of years, despite the price of uranium going parabolic, going up an enormous amount, they've been very cautious about bringing on new capacity because it's very expensive to staff that. And as a result, they've been buying uranium in the spot market at a loss. They're buying expensive uranium now to fulfill cheaper contracts that they wrote with their customers years ago. So they would rather lose money on a certain portion of their business than take on the additional expense of increasing mining capacity. So listen, I understand why people like those bets. And if somebody wants to tell me, hey, in a gold bull market, the gold miners will go up more, I get it. I totally understand. But to make that bet, then I'm betting that management is honest, that they're capable, that their labor costs won't kill them, that they accurately understand and represent what's underground, that they know what's underground. We've seen all kinds of fraud and stuff like this. Or I can just make the bet that Congress is going to keep overspending. They're going to keep debasing the dollar, and that gold will hold purchasing power against a fiat currency where more units are being printed. And I'd rather just have the pure play bet than have to deal with all of the other possible ways of losing money when I think I have a really solid way to make money. Sometimes it's better just to be straightforward and say, this is the exposure I want. I'm going to get this exposure.
If our listeners want a little bit more details about mining, I mean, Seth Klarman, the value investor, famous one, he wrote in Margin of Safety, he wrote why he doesn't normally own a commodity stock. So he talks about like maintenance capex, and literally there's hundreds of problems that can go wrong with the miner. I mean, the grades could fall, so the economics are not where they projected. You could have like the diesel price or the energy price going up. It's not just labor costs. I mean, there's all these other costs that could spike. With cost of capital now, Gary, you see it where some of these gold miners, even at like 2,200 gold, this miner, Argonaut Gold, was building a gold mine, but because their cost of capital was up and the mine wasn't on time and on budget, then they got in trouble.
Those are all great points. And Klarman is, he's a phenomenal investor. He's a really good writer. He's a really smart guy. And I understand all this. For me, a big part of it is when you buy these mining companies, your management says to you, we think there's a certain amount of good, valuable stuff underground. And you're running two risks. One, that they're right? That because they could be wrong. They drill holes and they take grades and they estimate. And those estimates are sometimes aggressive and sometimes conservative. But you're also running fraud risk. You could have a management team that says we really want our stock price to go up, so we're going to tell people things are better than they are. And there was a case. God, what was it?
Are you thinking of Briax?
Yeah,
There's a movie on that. It's with Matthew McConaughey. It got bad reviews because everyone's like, "Oh, it's fat Matthew McConaughey," but actually the movie's pretty decent. It shows like the mining scandal. It was a fake gold mine.
Yeah, and there have been other cases where core samples were salted, and what that means is, so you get the core sample, and then somebody took, a little vial of gold, a little bag of gold, and sprinkled some additional gold dust in there, and made it seem like the grade, the amount of good stuff underground was more than it was. And if I remember right, a senior executive of the company managed to somehow accidentally fall out of a helicopter.
I don't know which one you're talking about, but yeah, the juniors like misreport stuff. There's a lot of like adjustments there on the junior drill hole results. So I know people that gamble on those companies. I mean, I wait until there's like a bankable feasibility study, because then like the banks and the other geologists and stuff are all triple checking the stuff. But even then, when they build the mine, I mean, it doesn't come in on time and on budget. So especially with higher interest rates, cost of capital, I mean, the miner could still get in trouble.
Yeah, exactly. And listen, there are people who have made a lot of money investing in these stocks. And, my response is fantastic. Good for you. I'm cheering for you. I think precious metals, I think gold, I think dollar alternatives and commodities are a great investment right now. And, people who have the same thesis as me for the same reason, but choose to express it in a different way and have their portfolio structured differently, but are making the same bet, we're on the same team. I'm cheering for you guys. I want you to win. I've just chosen the pure play way to do it. I just want the pure bet, and I don't want exposure to all these other shenanigans. And it doesn't mean, if you're listening to this and you're invested in gold mining stocks, I'm not against you. I don't think you're wrong. I just want to be positioned with exactly what I think the problem is and make money from that analysis. I don't want to have to deal with, like you said, fraud or problems or diesel prices or labor issues or, executives falling out of helicopters.
Makes perfect sense. I mean, that's why personally, like, this is not investment advice, just something I've done with my own money. I've been buying Sprott Inc. shares for many years. I mean, they just create those ETFs. Like you said, they have a physical uranium trust. They have physical gold and silver trust. They just collect fees and manage those things.
Yeah, really simple way to do it. And from everything I've seen, I think, those companies are honest. I think they're doing the right thing. The potential downside that people talk about, and you're going to take this risk no matter what, is that, they could tell you we have 1 million ounces of gold, but if they only have 500,000 ounces of gold, you don't find that until everything gets unwound.
Well,
But that
that's
said,
GLD.
yeah, and that's been the subject of debate for years. Do they really have the gold? And by the way, it was the same thing with GBTC. There were all kinds of rumors that the Grayscale Bitcoin Trust didn't own as much Bitcoin as, they had sold shares. And, I knew people involved there. We made a ton of money owning it. And, from what we looked at, we thought that they were honest and that they owned everything that they had. And, we've seen since they became an ETF, they've had massive outflows in units because their fees are too high. But they've been able to redeem everything. They haven't had a problem yet. And, somebody could say, well, if they've had 50% outflows, if they were only 20% lying, then we wouldn't have uncovered it yet. And that is all possible. There's no way to know. But, whatever you're going to do, there's a problem. Like, a lot of people will say you should only own physical gold. All right. I get that. That's a great idea. But the issue with that is where are you going to put it? Right? Are you going to store, $100,000 or $500,000 or $1 million of gold in your house? If you do that, you better have really good security because it could be stolen. And people say, well, no, I'll put it in the bank. I'll put it in a safe deposit box. Not so fast. The FBI raided a safe deposit box facility in California a few years ago. Without a warrant, they opened every safe deposit box and they confiscated everything that was worth more than $5,000, including the assets of people who hadn't committed a crime, hadn't been even suspected of committing a crime, and took those people years to sue the government and get restitution. And it was years to get their assets back. And they might not have done it. Or, as we've seen before, President Franklin Roosevelt made owning gold illegal. And so, in that situation, if you got your gold in a safe deposit box, you better believe the government's going to figure it out and confiscate it. So any way that you want to own gold, you are running a risk that there could be theft or fraud. There's no way around it.
Yeah, I mean, I've heard stories of family members stealing other people's gold coins or bars. I mean, I was shocked when this was over 10 years ago when I was reading these stories. They were submitted anonymously because people don't want to blow the whistle on their own family member. But I was just seeing them happen. I was speaking to bullion dealers and hearing stories that it's been happening a lot.
Yeah, one of the big issues with gold, and again, I'm a huge fan. I own it. But there really are issues of, do you own it in an ETF form like GLD? Do you own the physical in your home where it could be stolen? Do you put it in a safe deposit box where it could be confiscated? If you store it in another country, do you trust the storage facility? And here's the best part about it, right? Because the storage facility right now could be reliable. Let's say you send, I'm making this up, 10 ounces of gold to a storage facility in the Cayman Islands, and they're very secure and very honest, and they act with integrity, and they store your gold there, and it's segregated. There's a little box there that says, Jason's gold. But the issue is they're acting with integrity and storing your gold and will return it to you now. But when you need your gold is in something hits the fan moment. And when that happens, in the Mad Max crazy, what if it all falls apart environment, good luck getting to that facility. Good luck getting them to give it back to you. People will often act in an ethical way during good times, but be very self-interested when things go badly.
Yeah, I agree. Rules can change. Goalposts can be moved. Rules can change. The ownership of the bullion trust or the bullion storage facility, it could change, and the new owners who just bought it could be unscrupulous. They could, lie about that stuff or change the rules. The other issue for American citizens, Gary, is, and we need people in Congress, maybe Thomas Massey or Rand Paul, we need long-term capital gains taxes for gold and silver. They need to change the tax laws. So if you bought your silver at $5 an ounce or something, bought a bunch of silver bars or gold coins back at a couple $100s, you're not paying a higher tax. So the tax needs to be locked in at long-term capital gains. I think that's something that Congress, both parties should work on.
Yeah, get them to do the same thing with Bitcoin too.
Well, yeah, a lot of people in Washington, D.C. metro area love Bitcoin. They're trading it like crazy now.
I find that really interesting, right? Because it's a huge threat to the fiat, to the dollar as fiat currency.
Oh, that's not why they're buying Bitcoin.
Yeah, I get that. But it's really interesting that their professional interests are in conflict with their personal interests. And when that happens, what do they do?
It's greed and selfishness, man. The government employee is like the old stereotype. What are the government employees is that they're supposed to be selfless and not greedy and not selfish and not trying to get rich quick. I mean, if you come here to Washington, D.C. metro area, you'll learn the opposite very quickly. There's actually a Bitcoin conference coming up here in D.C. I can't remember where it's at. It's called the DC Blockchain Summit. And there's tons of government employees there, and they're all bragging like, oh, I bought a lot of Bitcoin when it crashes, and then I'm going to make a lot of money on it.
I love that. I'm going to make a lot of money. Listen, I'm not against it. Again, I own a ton of Bitcoin. I just think it's funny when somebody's investment thesis is I'm going to make a lot of money. Like, did you do any work on this? But you know what, Jason, I'm with you. Maybe we should start a movement to stop use of the words public service for people who get paid to work for the government.
Yeah, I mean, they're not making smart investments long term in our infrastructure. It seems like every couple of years they pass an infrastructure bill, and I think this is an investable trend. It's the energy spending grift on ESG. I mean, like the return on investment on these projects, wind, solar, biofuels, electric vehicles, it's negative or zero. So, I mean, we still need cheap electricity. We need to actually invest in good infrastructure, and I think there's opportunity for the regular energy because of all the money the government's wasting on the ESG stuff.
Yeah, I'm with you on that. And again, that's why I own so much uranium. That really is the answer here. But I think there are a couple issues going on these infrastructure bills, and we've seen this happening for decades. When Obama was talking about $1 trillion of shovel-ready projects, great. Where are they, right? And and then I remember when President Trump was a candidate, when he was candidate Trump. He came out and he said, look, we need to build airports. We need to build infrastructure. He's like, I've built huge development projects. I know how to get this done. And at the time, I put this in writing, it's not going to happen. And this is not because, people will say, oh, well, Trump was a liar or Obama was this. That's not it. That's not it. The issue is go get something built in this country in 4 years or 8 years. You want to build an airport? Do you have any idea how many years it'll be before you're done with the community studies, figuring out the traffic flow patterns, the noise issues, the environmental concerns? You're going to have 7,000 meetings to get the architectural plans approved and the environmental plans. You can't build an airport in 4 years or 8 years. You can't build infrastructure in that amount of time. And then we saw the last infrastructure bill, based on the numbers I saw, 7% of it was related to anything that a normal person would consider infrastructure, like roads and bridges and things, capital investments that we use. The other 93% was actually consumption. They were social benefits programs. And here's the thing. If you're listening to this and you're saying, well, good, I want the government to spend more money on social programs. I want the government to give away more money. Okay. Fine. You're entitled to your point of view, and you can defend that point of view, but then let's call it spending. Let's call it consumption. Let's not call it infrastructure and pretend that, we're going to spend trillions of dollars, but you're going to have roads without potholes and bridges that won't fall apart. Right? I mean, that's what people should be thinking when they're thinking infrastructure. It shouldn't be spending. And I'd be fine with us having a really honest debate about, should we be spending money on infrastructure? Should we be spending money on social benefits? Should we be giving people food or shelter or medical care? Like we can have those debates, but they're meaningless if they tell us it's an infrastructure bill, which is a capital investment to make our lives better for decades, and what they're really making it is consumption and welfare and social programs, right? If we want to spend money on those things, then let's have that discussion. But let's not tell people it's bridges and roads.
Yeah, their office is gaslighting us. I mean, they're lying and they're sneaking stuff into the bills, and the majority of the spending in the bills is added on, and they're trading votes for other spending, pork projects and stuff like that. It's self-enrichment in Congress with the lobbyists and government employees. And now they're trading on inside information on the stock market, and they're outperforming really smart former hedge fund managers like you. But it's not because they're working hard. It's because they know the system. They're working the system. They're corrupt and they're cheating.
So let's talk about that for a second, because the language here is really interesting. Everything you just said is 100% true. But if you want to get really mad, right, you ready for this? A lot of what they're doing is legal. It is actually legal for members of Congress to trade on inside information. So if they know, for example, that they're going to spend, $40 billion trying to give that away to companies that make semiconductors, right? The chips bills, they can go buy, Intel and Nvidia or, whatever companies they think are going to benefit from that ahead of passing the bill. And that is legal. They can trade on legislation that they know is going to pass, but hasn't been publicly released yet or approved yet, or nobody's read the bill. And so the issue to me isn't that they're acting unethically. The issue is that acting unethically is actually legal.
Yeah, well, I don't think the founding fathers in the Constitution anticipated that there was going to be online day trading on people's smartphones and that people could leverage up on stock options really quick on the information. I don't think they thought that far ahead.
I'm 100% certain you're right on that. But it would be really interesting. The thing I'd love to see is for Congress's insider trading exemption to be revoked, and then I'd be curious to see if there are ever any prosecutions. Because I suspect in that situation, district attorneys would be or federal prosecutors would be exercising prosecutorial discretion and saying, yeah, we could indict them, but we don't want to.
Yeah, I agree. The white collar criminals, I call DC the district of criminals now. It's both parties. Most of them have law degrees. They're doing insider trading on stocks. They're stealing stuff, unbid contracts for friends, revolving door of corruption. And then a lot of them are even doing charity fraud. So there's a long list of the stuff they're getting away with. And a lot of it's because, like you said, they know the legal loopholes, or they know the stuff's technically not illegal, or they have friends in the who won't prosecute them for it.
Right. And I'm always amused by the partisans who say, well, your guys are crooks and criminals, and my guys, they're just trying to help the country. Okay, but Jason, you're right? Theft and venial behavior it's a nonpartisan issue.
You are truly a wealth of information, Gary. I feel like I can keep you for another hour. I want to thank you so much for your time today. Please tell my listeners more about deep knowledge investing.
Thanks so much. Thanks for having me. For people who are interested, Deep Knowledge Investing provides our subscribers, our clients, with a very limited number of high return, high probability, high alpha stock picks. Again, so far we've had more picks that have gone up by more than 100% than we've had picks that have lost money. I make no promises that I can continue doing that, but certainly we've got a track record of getting things right. We're not a high volume shop. Right? We're not going to hit you with an idea a week. My goal is to find a few things a year that the market doesn't understand, where the market is missing something. And then I explain to you, I'm putting my money in this. This is why. This is what I think the market is missing. This is how I see things differently than other people. And then you're free to make your own decisions. You can trade it with me. You can you can ignore it. You can read the report. You can ping me with questions. But, it's still your money and you keep it in your account. But we've done a great job helping hedge funds, family offices, high net worth individuals, and just regular people who maybe have a few tens of thousands of dollars in a Schwab account or an E-Trade account or a Robinhood account. The other thing we've done is we provided people with great macro analysis. And I'm really proud of two things on that. One is we talk to people in plain language. If we use finance speak, we explain it. But for the most part, we just explain things in a really simple way. And, we've often been at odds with the mainstream financial media. And we explained to you why I told people this is why we're not going to have 6 interest rate cuts this year. And, we've made money from it. We were shorting the market in February of 22 ahead of the COVID shutdowns. We were preparing people for inflation in November of 21 when Chairman Powell and Secretary Yellen were still saying it was transitory and not a big deal. We were saying it's a huge deal. That was the first half of the report. The second half of the report was don't panic. We're going to show you what to do and explain to you how to protect your home, your portfolio, your finances from this. So we've done a really good job helping people. For people who are interested in that, you can find me at deepknowledgeinvesting.com. If you have questions, feel free to reach out to me at ir@deepknowledgeinvesting.com. And I read everything that comes to that address. We respond to people and, be happy to welcome some new subscribers.